We can clearly see euphoria in the markets at this time, there's no doubt. Based on many indicators, the market is overvalued beyond any previous cycle we have ever witnessed. The Federal Reserve has provided more support than any recession, and this has funneled its way into massive speculation. Nobody would dare suggest removing the so-called support, and so the bubble continues to grow. But it's going to end well, right? You came here for the truth, so let me unveil that for you today. We are going to look at the melt up or down. This is important because we can see the news coming out of the markets. They're saying buy, buy, buy. You turn it on CNBC and Bloomberg and any other financial news media, and they're telling you to buy. But what they aren't giving you is the financial education, is the indicators, and all of the foundational principles that are being thrown out of the window that eventually make their way back around. Nobody wants to talk about it. Nobody wants to look at it. But I know there's a small group of people out there who actually want to know the truth. You do what you want with your investments. You have to decide for yourself. You don't want to look out there and find somebody telling you this is what you're going to buy, that's what you're going to buy because the price was here one day and now it's there. Don't miss out, don't miss out. No. You want to make educated decisions on your own. So I provide you some data. You can go out there, find data from other sources. Do not ever go to one source. Always look into this deeper and deeper. Today, I'm going to show you some really good information. We're going to want to look at the economic factors. Of course, we're going to look at the stock markets. I've got a lot to show you today, so let's begin. Yes, the NASDAQ. This is the extreme that we've seen here. This is in fact the tech boom 2.0. When you look at what's going on in the economy today, we are seeing numerous corporations that are going bankrupt. We are seeing people and their delinquencies rising. We are seeing the expansion of debt. There has been so many different factors which are at a record level today, and yet on the opposite end of the spectrum, we see the NASDAQ roaring to record highs. It seems rather unbelievable, but there's always an excuse that you see, especially from the amateur traders. They are piling their way in, and so far that has looked very fantastic. That really depends, of course, on where they bought in, but at a record high, it would seem that their 7 shares of Amazon have really done well. There's no doubt about it. This is a chart that's provided by Real Investment Advice, and essentially what we're looking at here, all across the board, everywhere but bonds, is overbought and significantly overbought. That's what it's telling us. And it just shows you that we have entered a time that is beyond euphoria. We are in a stage of unicorns and fairy dust. This has gone beyond normal. We're just in this ridiculous territory today, and it's all thanks to the Federal Reserve. I want to talk a little bit more about the Fed in a minute, of course, but essentially what we have is unlimited support, and the market knows that, so the speculation is definitely on the table. FANG stocks were trading in a range here from 2018 all the way through into 2020, but now have accelerated far, far beyond that. We are looking at them here on this chart. You could see how they have risen high. Look at what has happened with Amazon. Obviously, the performance has been unimaginable, as you can see that really all the statistics, the PE ratios and traditional ways to value these particular stocks, they don't make sense anymore based on what we're seeing, because you wouldn't have this mass rush into buying them all up. There would be a lot more concern, a lot more hesitation, but today there is no such thing as being concerned. You don't have to worry about anything, in fact, because you have a central bank that is there to backstop any losses, or at least that's what they're telling you. In an absolutely unprecedented rise in this particular stock in one single day, we have to look into it deeper and understand why. Well, look at this. FANG DD, or FANG, China real estate firm, adds 395% in mystery move. What exactly made this stock go up? Maybe they had risen because their performance was really well. Maybe because they had some sort of technology that is coming online. Well, no, actually what has happened here is that a whole bunch of people thought what they were buying was FANG stocks, or perhaps a FANG ETF based around this, and they actually pushed the stock up in a single trading day. This is when you know that you've got a serious problem of speculation. This is a very, very good example of that. If you want to know what's going on with the stock market, you want to be able to anticipate what we are going to see, you need to understand the global liquidity proxy, the money supply that has accelerated along with the stock market. It is very clear, you can see it right here, whether we're looking at the total money supply, and if you want to look at the global central bank balance sheets, doesn't matter. What I want to know is how much money is moving into the system, how much money is being pulled away. Liquidity is everything. I've been talking about this basically on every single video ever since 2018. I was telling you back then that if the central banks continue to reduce the liquidity in the system, stocks would have a hard time. And you could see very clearly 2018 was a terrible year. 93% of assets were in the red. And then that changed. Of course, you know what happened. Stocks came up and they just were riding that speculative bubble that was happening. And it has really, really gone beyond what anybody expected at this point here. But you can see the correlation between the two, just showing you on this chart. But we can pull this chart back several years if you want, and you see that essentially the same thing, is that as they print money, it pushes the stocks up. If they reduce the amount of money that they're printing, stocks come down. This correlation here is very, very tight, though there are variations throughout periods of time. Ultimately, we know which direction they're heading. A Buffett indicator variant, Wilshire 5000 to GDP. My goodness, we have hit historically high levels. It shouldn't surprise anybody, of course, because this is the direction that they've been heading with the money printing, with the speculation. So why wouldn't we go off the charts and all of the different indicators? It looks quite familiar from back during the dot-com boom and bust, but today we have gone even further than it, and based on what we're seeing in the news, it doesn't look like it's going to stop anytime soon. Well, I don't know what's going to happen in the future. There have been so many indicators which have risen to record highs, and yet we continue to surpass them. Many have been calling for a market crash, but with the Federal Reserve support here, what could possibly make it decline? That's a good question, of course. It remains to be seen. I showed you this just recently, maybe 2 days ago or so, but we're looking at the equity put call ratio, essentially showing us that people right now are the most bullish they have ever been. Nobody thinks that the market is going to come down. When you look at it in this case here, it just shows us how much support the Federal Reserve and the other central banks around the world have been providing. The situation with the economy, very, very different. The economy is just destroyed. But when you look at the market, my goodness, it's like not even close. It's not even close. And that is historically an anomaly. This chart here provides us an interesting look because we can see the M1 money stock, which has really spiked upward along with many other things in 2020, yet the velocity has declined, and that's not a good thing. The Federal Reserve has essentially in many cases talked about this, but their quantitative easing policy, the reduction of interest rates, this whole ridiculous notion that you can print money to help the economy is a failure. And there have been these admissions that I've been showing you here, but typically they're not going to mention that at an FOMC meeting, obviously. But this is just showing you what they're trying to do and the actual results. PE ratios continue to rise, and that shouldn't surprise anybody because everything right now is off the charts. Nobody even cares about this. Nobody even looks at this anymore. But I thought I'd let you know that the S&P 500 PE ratio 22.6. If you look at it specifically for the information technology sector, 24. This is historically just way off the charts. It's around 16 to 17, what we can see on average, and we've gone far beyond that. This is just one example when you know that things are just acting completely wacky. The green line there, that's the S&P 500 railroads, and you could see that as an index. Look, it's been rising along with everything else in the markets, yet the actual total traffic on railroads has continued to decline. You've got something wrong when this divergence occurs. This article here is just making a point that I wanted to cover very briefly. We'll move on. This rally is a function of government support being thrown behind the economy. There are key risks that could lead to more volatility ahead of over the short term, which is why we continue to hedge our portfolios to the downside while still looking for opportunities to add risk for the medium to long term. How many people do you know are actually hedging their bets? Essentially right now, zero. Zero people are doing this because they see no risk. This company here, talking about BMP, they are at a point where they see that there's a lot of upside, but there's also risk. So they're just hedging their bets. They're still looking for opportunities. They're still investing, but they're just hedging their bets. And I think that's really wise. It's prudent to do so. And unfortunately, too few people do it. Just wanted to make sure I mentioned this here. I did cover it in a previous video, but the expectation, according to CoreSite, who manages all of the store closures, who calculates that all, keeps tabs on it, they expect this year 25,000 stores to close in the United States. They do mention the fact that yes, the US has way too much retail, and that is very, very true. Last year, you could see the record that was set, 9,800 stores closed, and now they're surpassing that by a landslide. We'll see what happens here. I'll bring you the numbers as we go through the year. This article here is just talking about the food shortages. It's important to understand what's happening here. I think that we should be looking at this on a different level. This is one factor. You could see that there are the potential for food shortages. Depends on where you live, of course. It depends on the type of food as well. But there's one thing that's very clear. In these type of foods where you have a shortage, whether that's temporary or not, the price escalates, and we can see that food inflation can rise. Specifically when you see it really broken down here. I would love to get some new numbers on that, and I'll provide them as soon as I can. Really quickly, a couple more things. The proportion of zombie firms in the US has risen substantially. That's not a good thing. We're comparing here the blue area, which is 2000, and the orange 2019. This is going to be much worse when I get the 2020 numbers, but nobody even cares anymore. Nobody cares. This is the time in which everybody just goes all in and hopes for the best. Looking at different indicators helps us to get a proper perspective, to give us some insight as to what's going on. We don't want to look at necessarily PE ratios to be able to think, what's going on here? Well, you're not going to see the big picture if you're looking at a PE ratio. Top left corner, we're looking at traffic in different cities. Top right, we're looking at restaurant reservations. We have to look at these type of factors. There's more here, traffic and so on, but it just shows us that what we are seeing isn't what we're being shown in the markets. The markets are not giving us an accurate view of what's really happening. And one of the most important things today is, I put it right at the end here, all of those people who are already left the video are not going to know, but US exports to China are absolutely nowhere near where they said it would be. I did so many videos about the trade deal telling you how this is impossible. There's no way that they're ever going to be able to meet their goals. And they said, oh no, they're going to. I saw so many comments. I saw so many articles. People were yelling and screaming, and yet it's very, very clear. These yellow dots here are just showing you realizations 2020. Look, it's not going to be anywhere near what they've promised, and that's not good for the industry as a whole. All those that are affected by this, there are some serious headwinds ahead, and the market may haven't priced that in at all. That's all for this video. If you found it informative, please give me a thumbs up. When you do, you are supporting me, so thank you very much for that. If you want to check me out on Instagram and Twitter, you can do so at The Money GPS. If you wanted to learn how to sell online, I've got a free e-course. Unlike all those other people charging $1,000, $2,000, this one here is free. It will get you in and you don't have to pay a dime. Check it out at theamazongps.com. If you want to understand the financial system, where do you begin? Well, these two books right here break it all down. Very simple, and you will get so much out of them no matter how far into this process you are. Check them out at the link in the description if you want the audiobook, themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? It's so important. There's a lot to it. Check it out. I'll see you there.